Hello everyone and welcome back to the final video for October. I have my son with me right now. He's been kind of spitting up a little bit tonight, but I'm determined to get this video done. So please don't mind the baby cooing noises and random sounds that may come from my child. And let's get through this thing. So, for our disclosures, always, I'm not a financial advisor. I don't claim to be one. The article reflects my personal views and is not indicative of the opinions or views of my employer. I do hold a number of positions similar to what John has in his account, and I have those listed. And these are actual shares being traded in a real portfolio. So, this is not play money or anything like that. It is a real account. And that is why I include as many screenshots as I can to further, validate that it is real. So the why I do this piece, I do this because I don't like seeing people being taken advantage of. And in this case, John and Jane had a situation that I felt that they were unjustly being taken advantage of, and they decided that they would like to just take control of things on their own. So in this case, we decided that basically in exchange for me helping them do this, I just asked that they allow me to make these videos and talk about their investments and kind of the journey that they're on and document it, so that I can help others potentially improve their situation if that's something that they want to do. So for their background, John retired in 2018, Jane retired in 2021. Both of them collect Social Security, but from the taxable account, they take $1,700 a month, and then the John's traditional IRA, he takes currently $1,000 a month. So they do have other investments outside of what I help them with, primarily consisting of low-risk bonds and CDs and things of that nature. John and Jane don't have any debt or any monthly payments other than basic recurring bills. So the idea here is that they have set themselves up very well for retirement, and that makes my job of helping them super easy. So I think this is a very often overlooked aspect of discussing, preparation for retirement. So in this case, I really appreciate that they have done everything that they can to make my life easy helping them. So in the traditional IRA, the account generated $1,122 in the month of October 2023, and that compares to $1,304 in October of 2022. And then in the Roth IRA, they generated $982, and that compares with $812 in October of 2022. So slight, well, I shouldn't say even slight, but modest decrease in the traditional IRA income, and then in the Roth IRA, a very modest increase. So the traditional IRA had a balance of about $320,000, and that compares with $350,000 for October of 2022. And then the Roth IRA had a balance of just under $199,000, and that compares with $203,000 in October of 2022. So 5 companies in total paid increased dividends or special dividend during the month of October, and no companies decreased their dividend payout. So for the dividend increases, you guys have already seen that Main Street Capital, that's from Jane's portfolio. And then also we have Altria, which is also from the taxable portfolio. And then Realty Income, you've seen that one along with WP Carey. And then for Bank OZK, that is the only one that we haven't discussed in previous videos. And OZK consistently does a penny per quarter, and that stock has been on the upswing. Everything's been performing really well with them. That bank has been trashed previously, and that's why we have shares at such a low cost basis. because for a while there was a lot of negative sentiment around their they call it their Res G portfolio, or real estate. Basically, it's their development real estate portfolio, and they had a couple loans go bad, and people started speculating that the whole thing was bad. But nope, it has performed very well since then, and I think that we're looking good, and we really like Bank OZK. Wish I could have grabbed some more shares at the lower cost basis, but didn't think to do it at the time. So for Main Street Capital, John's sitting on some pretty substantial capital gains, and then also since that has been established in John's portfolio, at least back to December of 2019, has collected about $4,500 worth of dividends on top of the capital gains that you see there as well. So in Main Street, we'd be looking at shares of about $35 a share before we would be adding to that position again. And then for Altria, I mentioned this in the other articles as well. Sorry, not articles, videos as well. Wouldn't be looking to add to this position unless we saw shares really drop down, probably into about the mid $30 a share range would be the first place I'd actually consider it again. But it's still producing dividends. But really it's the regulatory atmosphere around smoking that concerns me the most in terms of the long-term sustainability of what the company offers. So Realty Income, talked about them quite a bit in the other videos. They're performing quite well. Their stock's kind of on a slight upswing after hitting 52-week lows, and is in the process of acquiring Spirit Realty. So they've been producing a substantial amount of dividends. So even though at the time the screenshot was taken, it was sitting at a loss, we are looking at getting rid of some of these higher cost shares here, because then we can just keep these lower cost shares. We'd be looking at pretty much a break even if we didn't have some of these higher cost shares that we have. And then for WP Carey, this stock has bounced back significantly, and as you can see, the share price at the time I took this screenshot is at least, I think it's about $5 less than where it currently is at. A lot of people abandoned ship on WP Carey after the announcement of the spinoff of Net Lease Properties, and the potential dividend cut, or I shouldn't even say potential, but the dividend cut that'll be coming from that. I still think WP Carey, I think that they made the decision they made with probably a lot of good reasoning and thought behind it. And so I think that we're probably talking about a higher quality company than what it was prior to the spinoff. So in this case, I'm not willing to jump ship, and frankly, the share price recovery that we've seen helps definitely justify why it wasn't worth jumping ship on this one. So we've collected a pretty substantial amount of dividends since January of 2020 on that position. So for the October trades, you can see where we bought another 20 shares of Lowe's. So basically I set a limit trade at about $190 a share. That's where the current position lies. And in this case, got the extra benefit of it dropping to $188.90. So we doubled the size of the position there. We would be looking at potentially selling that position again if the share price moves up, probably in about the $220 share range. I just think at $220 Lowe's, it looks very not overvalued, but there's just no reason for there to be much more upside from there on it. So in this case, I like Lowe's, but I think at $190 a share, I think there's a lot of good upside, and being able to sell off a position of 20 shares at a gain of $30 a piece is a pretty worthwhile use of the money. It tends to, if we pull up a graph, you'll see that it tends to ebb and flow between that, or between the 190 to the $220 marker. So we also added, or sorry, not added, we sold some of our shares of CSX. We now have a cost basis that's entirely under $30 per share. So with where the stock price is currently at, we're sitting at a very nice gain associated with that. So we have a really good solid position to build off of, and so I like CSX. I like railways, and but in this case, I want to make sure, especially because of the lower yield, that we get in at the right price, and under $30 a share is a good place for that. These shares that were sold were definitely the higher cost shares, and you'll see that here in just a minute. And then Stag, same thing, where we just sold off some of the higher cost shares that we have. I believe everything that we have now is under $30 a share. So that was the main reason for having sold off those 50 shares. And then we added a $15,000 CD, in this case at 5.4% on 2 years. So at least, hold on, should do 2024, it's less than 2 years. I apologize. I might have that one wrong. I don't have my screen up to remind myself which one it is. I've got a lot of CDs, but I think it's due in this case in January. So this actually to me looks like a very short-term CD, like be about the span of about 3 months. So, and then as far as the Roth IRA goes, we had more trades in here. We bought some more Prologis, so PLD. Now that it's dropped down to the $100 range, it's since recovered significantly, and we've sold off our highest cost basis shares in PLD, because now we have very low cost basis relative to where the stock price is now. We sold off Southwest Gas Holdings. Too much going on there with the IPO of I believe it's called Centauri, and frankly, right now for the yield that's coming from it and the volatility that's there, I just don't see a benefit in holding Southwest Gas Holdings. So selling it just made more sense. I'd rather put that money into a CD and earn in some cases actually a better yield. And then Sun Communities, bought a few shares there. Pepsi, sold off some shares there. With Sturgis Bank, so we did a CD, and in that case, again, that's also a very short-term CD, looking at it being due here coming in January. And then for Prologis, again, bought some shares at 110. So as you can see here, between the beginning and the end of the month, it was a pretty big drop. And then on this, so with Stag, made a little bit of capital gains, and with CSX, made a little bit of capital gains. But again, the main thing was to reduce the higher cost position shares, and that was the reason why we sold those off in October. And then on here, Southwest Gas Holdings, you can see that we sold it at a loss. Again, the big thing is that I just don't, I haven't even paid attention to the stock recently, and so it looks like it's gone up a little bit since then, but I just don't see the point in holding those shares. And then with Pepsi, you can see that we sold those off at a modest gain on those 10 shares, actually a pretty substantial gain, really. And then year-to-date numbers, you can see compared to Jane's numbers, we haven't sold off or had as many trades in John's accounts as we have with hers. So things have remained more steady, I guess you would say. But you can still see that overall net gain-wise, we've sold off some of the winners that we have Really still the goal has been just reducing those higher cost share positions and then recycling the capital into other better opportunities. So as far as the comparison year over year goes, we can see that CLDT reinstated a reduced dividend, whereas the previous year they didn't have a dividend at all. Occidental Petroleum has started offering some pretty compelling year over year increases now that their operations are much more solid than they were 1 to 2 years ago. 2 years ago, I mean, I think the stock price was down in the low teens, or even might have even gotten to the single digits. And then there were, in 2022, there was $130 worth of dividends that came from positions that were eliminated. So in the month of October, part of the difference of what we're seeing here too is that some of the companies or the shares that we sold off were the ones that actually paid those dividends during the month of October. So that helps explain some of the difference that we're looking at. And also you can see, like with QYLD, it paid in the month of October in 2023, but it didn't pay in the month of October in 2022. So some of it's just timing issues, but the big one's going to be like with TD, so Toronto Dominion, the reduction that you see there in terms of the size of that position. And then for the Roth IRA, so the Apple Hospitality dividend has continued to grow. That stock has been performing quite well as well. So everything seems to be on the uptrend, I guess you could say, from here. And then also we IRM. We trimmed that position back, so that's part of the reason why we're seeing a reduced amount of income coming from them. We took the gains basically at record highs. Those record highs have continued to push a little bit higher, but we still like the position. I just thought it was a good time to take some off the table. And then with Sun Community Properties, that position has more than doubled in size since 2022. And then some of the utilities, so we've mentioned with like SWX and PNW was another one that we had. We took those ones off the table once the stock price, with PNW when the stock price went back up, and just decided that in favor of putting more money into UTF, that was the better investment at the time for the yield that we were going to get. And also UTF has had a very strong recovery in the last couple of weeks. So we're seeing that head in a good direction as well after hitting some lows that haven't been seen since COVID. And then for the full year comparison, so basically we're looking at an estimated 7% decrease in income in the traditional IRA, and that is worsened from 6.3% in September. So that's partly because we saw the income go down relative to what income was received in October of 2022. There's some explanations for that. Part of that's going to be the special dividend that was received in July of 2022, and I know I've discussed that in the previous videos. So when we take out that special dividend, then we're looking at a positive year-over-year growth. But I still think I'd rather err on the side of safety of reporting something that's not nearly as attractive, because I don't know, I just feel like it's a more honest thing to do. So as far as the Roth IRA goes, that is up substantially, so 16.6% increase In September, it was standing at 16.1%, so that's increased yet again. And then remember that in yellow, that does not include CD income in those estimates. So again, trying to err on the side of safety, of not making something look too good or too attractive. And then as far as the account balances, you can see those. One thing I always like to do in John's account is add back in the withdrawals that have been taken out of the account. So in this case, it's $12,000 year over year to be added back into the account. So if we took that, added it back onto the 319,000, we'd be looking at about a $19,000 decline in the account balance year over year, versus right now looking like it's a $31,000 decline year over year. So the 6-year growth trajectory, again, you can see the reason why it's saying that it's looking at 7% negative growth, and so from here to here. But also we can see that it would still have been negative either in 2022 when we removed that special dividend, because from here to here, that's just specifically, I guess, for the month of October. But that also has to do with the timing of when those dividends come in, because still we can see that it's been a substantial growth trajectory when you compare 2021 to 2023. So yeah, October's down a little bit, but that has more to do, it looks like, with the changing of when dividends are paid, or the positions that are being held in there. So, and I mentioned over here on the bullet points that $2,400 of 2022 was a special dividend from Healthcare Trust of America being acquired by Healthcare Realty. So basically, if we were to factor that back in, that is why I say that I know this number would end up being in the positive. So for the Roth IRA, every company has reinstated some form of dividend payment, even if it's not quite as high as it was before. So John's Roth IRA was particularly hit hard because it had companies, especially real estate investment trusts, that were dependent on renters paying the rent. And so in this case, now that they've reinstated their dividends, that's part of the reason why we've seen such a strong growth here, was because we saw such a negative hit in 2020 and 2021. And then the cash balance comparison. So John currently has $45,000 in CDs total and $40,500 worth of cash on the sidelines as of November 22nd, 2023. And you can see that that doesn't necessarily match up with the tables above. And the reason why is because the tables above represent October 31st numbers as based what's on the statement. So there's a delay between the cash on hand and the tables as compared to that second bullet point. And then for the Roth IRA and the traditional IRA, they're both sitting at potential losses. The dividend income has increased significantly, in particular with the Roth IRA, and basically the Roth IRA is actually sitting at less of a loss now than what it was, simply because the market has improved quite a bit. But also, again, backing out that $2,400 special dividend received in 2022 in the traditional IRA, the income has increased there as well. So basically, both portfolios are doing what they're intended to do, to produce income during unsteady times. So even though you may look at this table and say, oh, things aren't going so well, the important thing is that are the companies still able to pay the dividend, and their provide income to John and Jane. And in this case, when we get to the next slide, we look at the withdrawals. John's account produces more dividends than and more income than what John withdraws. And when we look at the RMD that is going to be associated with John's account, which I believe I'll need to have them remind me based on their age whether or not they're actually due to do an RMD this year or if it's next year. But if the RMD was due this year, it would be $14,111.48 to meet that, which would be just under about $1,200 a month. So he's taking slightly less than that. But the but the account is producing quite a bit more than that. So in this case, it's on track to generate about $1,380 a month, and he needs $1,200 a month. So the balance is going up and down, has much less of an impact as long as the income that's being produced meets the needs that he has, and the longer we can maintain that RMD without needing to actually sell shares, the better off John's going to be and the less risk that his portfolio presents to him. But that's also why we're more in favor of, transitioning to CDs and things like that, especially in the current rate environment, because that way we don't have to deal with the volatility at all. If we have CDs that are producing at 5.5%, we'll take that any day. So as far as the table goes here, you can see there's a lot of volatility between the holdings that he has. Again, these numbers have improved quite a bit since this was last updated, simply because the market has improved quite a bit. So we were looking at about $16,102.21 at the time that this snapshot was taken. And again, that more than covers the $14,000 some odd dollars that John needs to draw in order to meet his RMD. And then for the Roth IRA, there is no RMD requirements, so the benefit here is that as long as everything keeps producing income, John never has to draw out or sell any of his shares in order to meet that if he doesn't want to. Of course, he could sell these at any given time, but there's I had a question the other day or a comment left on the taxable account video, asking, how do you choose which buckets to take it from? And my thing with the Roth IRA is that you would never want to take it from the Roth IRA unless it's something where you want to use the money. And the big reason for that is that why take money out of a Roth IRA and then put it into a CD or invest it into stocks or do something that's going to now put it in a taxable status. Whereas in the Roth IRA, if you draw $1,000 out and your plan is to use that $1,000, great. That's a great reason for taking that $1,000 out. But if your plan is just to say, hey, I need to draw some money out so I can invest it, the Roth IRA would be a terrible choice, simply because you're just going to create more taxable liability for yourself by investing into something that's now taxable. So hopefully that makes sense to everyone. As to why the Roth IRA needs to be something that you only take the money when you actually intend to use the money. I would say, especially if you're planning on doing like a large purchase. So instead of doing a car loan at 7.5%, for $30,000-$40,000, if you want to draw all $40,000 out of your Roth IRA to go buy that car, that is a great use of your money if that is what you want to do. I'm not saying buying cars are necessarily great ideas, even as someone whose job is to finance cars for people. I think there's going to be a better time to buy them in the future, but the point being that it is a great way to buy something that is a big ticket item. And then that way there's no taxable consequences. So it's not like drawing $30,000 or $40,000 out of a traditional IRA and then now having to include that in your taxable liabilities. So Market has rallied going into the end of November. I mentioned in the previous videos, I don't think it's warranted, and that's part of the reason why we're more in favor of holding cash and fixed income investments. So the current gain loss table is definitely showing a much more negative picture than what we currently have. And that's partly due to the timing delay of when those screenshots were taken. So John needs to pull an additional $2,111.48. Again, assuming that he actually is due to do his RMD this year. That's something I'll need to check with John and Jane on if they actually are required, because I can't remember how old they are exactly, but I know it's either this year or next year that John's going to be due for it, because that's why we started drawing $1,000 a month out of his account to basically just get started in that process. So in this case, the portfolio generates a bunch of free cash flow, and that is definitely the goal of what we want to see, because we need their account to continue generating income as long as possible, because that's what's going to allow John and Jane to continue living very comfortably. And in a sense, I like to compare it to making their portfolio in a way kind of pensionized, almost like a mini Social Security, a self-funded Social Security, where it's just run off the investments that they've made, and provides them that safety that people love pensions for, right? It's that certainty that they know, but also that if they're expecting annual increases and things like that, it's going to do that as well too, as long as you have it invested in things that are going to grow the income. So anyway, sorry if it's been a little bit hard for me to keep focused. Sawyer has been a little bit fussy tonight, spit up a little bit. I'm sure I smell like milk right now. But thanks everyone for watching. Let me know if you have any questions. Love it when folks leave comments and ask questions. That's definitely some of my favorite stuff. So don't hesitate to leave any feedback, thoughts, or anything that I can help out with, or even just interesting thoughts, because that's the stuff that really kind of makes me enjoy this the most, is knowing when people are engaging and that they're finding some value in it. So anyway, thanks everyone for your time. Have a great night.